Hey guys, big news today. Obviously the OCR decreased from 5.5% to 5.25%, a whole 0.25%. It's good news. It's good to see that we're finally in a falling rate environment. For consumers, bear in mind that up until this OCR, the Reserve Bank was forecasting not to decrease it until the end of next year. So this is a significant move by them, and it is a significant shift in their stance. If we look at their forward forecast now, they're forecasting an additional 2 decreases by the end of the year. That'll be in October and November. So we'll end up, based on their forecast at least, with an OCR at 4.75 by the end of the year, and then a further 1% reduction next year, with the OCR ending up at about 3.9%. Great news for borrowers, right? That means that we should track back to mortgage rates around 5% by the end of next year, significantly below where they are today. In terms of the overall economic impact of this, I'm not really expecting much. The economy is weak, and that's what the Reserve Bank's responding to. It puts a little bit of money in people's back pockets, but the reality is that people's balance sheets have been really damaged by the last 2 years. Households have used up their savings, businesses have used up their savings. So if anything, if people are finding a bit more money in their back pocket, the chances are they're going to save it, or they're going to pay off other debts that they've accumulated. So I'm not expecting to see people rushing out to buy whiteware or new cars. So the economic impacts are going to be quite muted. Recessions in reality last years. They take a long time to recover. But what we should start to see is a gradual recovery. We should start to see a gradual improvement in consumer confidence, because there's light at the end of the tunnel. The pain that people have been experiencing, particularly in the last 6 months, will start to ease next year. That's got to be a good thing. As far as the housing market's concerned, again, I'm not expecting this thing to take off. Anyone that kind of forecasts that's got rocks in their head. You're going to see a gradual recovery. We don't have high levels of immigration. Interest rates are still relatively high, and people's balance sheets are shot. So I think you'll get a bit more equilibrium coming to the market, a bit more of a balance between buyers and sellers. That will underpin house prices. We should see some stability there, particularly for entry-level housing. There will still be parts of the market, I think, that will experience softness. But basic entry-level housing, should be underpinned by falling rates. If anything, we'll get a bit of a gradual recovery in house prices coming through next year. Now, I'm not really thinking about that as an increase. I'm thinking about a partial recovery of the fall in house prices that we've experienced. Now, that might only be 15% in nominal terms, but in real inflation-adjusted terms, house prices are down about 30%. So we're not going to see house prices take off, but we'll just see a little bit of a recovery.